your initial reaction to all of that?
So we, as like other economists, sort of take the Statistics Canada flash estimate as better than we can come up with on our own. This time it didn't do so well, so we figured that they were looking for a roughly 3% decline. Maybe that's what it was. It wasn't as severe, but we were expecting to see a very nice rebound in February. And again, their early estimate shows exactly that. But this isn't an economic story at all, actually. This is just a story of lockdowns, unlockdowns. You know, you say open sesame and the stores are allowed to open, and lo and behold, yes, we get more activity. Unfortunately, looking at what's happening with the virus now, where clearly, maybe not so much in Quebec yet, but in Ontario and some of the other provinces, we're in a third wave. You know, wouldn't surprise me if April we start to see some tighter restrictions. So we're seesawing with the COVID waves as opposed to the economic news. There's lots of spending power out there in the household sector, but for the most part, it's going to respond to whether we're allowed to shop the way we normally would or not.
And as you know, Avery, I mean, the big conversation here on BNN Bloomberg and in the markets recently has been, well, we're seeing all these signs of growth, and we're still talking about governments throwing a lot of money into the system and central banks that are still putting a lot of support into the system and keeping rates low. But you're kind of getting to something that maybe we've been talking less about, the fact that we are still at the mercy of this virus, and maybe that's why the central banks are staying pretty committed to these low rates for now?
Well, right now, you know, the economy in the U.S. and Canada still has pretty high unemployment. So remember that some of the stimulus is just checks going to people who are unemployed, wage subsidies going to the businesses that are still struggling. So those programs are continuing. It's really the U.S. more than Canada that now is really putting the pedal to the metal in terms of additional stimulus beyond that. Canada has some plans for that, but not nearly on a relative basis as big as the U.S. And we do question a bit, the conservative forecast that the Federal Reserve has for growth beyond 2021 rather, that even with zero interest rates is going to start slowing dramatically. I think we've got years of spending power waiting in the wings, you know, enough to get at least a couple of good years of economic growth. But my caution is that, you know, we're going to see this seesawing in numbers for a while until COVID is behind us. And as the health authorities keep telling us, it is not behind us. So what the governor of Texas is telling people, which is take your mask off, go out and party, not the best advice for COVID and not the best economic forecast either. I think we're going to see, particularly here in Canada where the third wave is very apparent, we're going to see some of this seesawing in data for a while.
You know, sticking with the seesaw or the open sesame analogy you were talking about, you know, it has been nice that Stats Canada has proactively given us, as they're going through it, little tastes on where we're going. How accurate, though, is the data right now on e-commerce? I mentioned that startling figure that they just shared for January, that retail e-commerce was up like 111%. And, you know, you start doing the math on it and you're like, well, literally, if people couldn't go to stores, they're going to spend online. But it does feel in the moment here like our economy is being reshaped in front of our eyes. Are we fully reflecting the e-commerce transition, do you think, when we're measuring the economy right now?
No, you're right. Actually, we're not. So that captures the e-commerce arms of Canadian retailers or Canadian-based e-commerce companies, but it doesn't capture foreign-based e-commerce companies. And I think all of us can think of at least one big one there, where you see the Amazon trucks going by my front door seems like every couple of hours, someone on my street is getting a package delivered with that little Amazon logo on the box. And so we're not actually getting the full story. And you're absolutely right. We're understating this. Now, is this permanent? No. People will go back to wanting to try on a sweater in a store rather than chance that they've got the right size and order online. But clearly, online retailing will retain some of the market share it's gained here. But when we think about consumer spending, remember that it's not goods consumption that's really been the weakness here. It's services consumption. In fact, if anything, we are buying more stuff than ever. during this pandemic because we're stuck at home. We're buying extra office supplies for our houses that we normally wouldn't buy, an extra computer for the kids who are now studying from home, and so on. So actually, there's been no big problem with goods sales overall. It's services, and within retailing, it's the kind of goods really where you do want to go to the store. So, you mentioned that clothing, for example, was an area that was hard hit in January. When the stores are closed, to some extent, you don't shop as much for things like clothing that you'd like to try on. And also, when you're not going out, do you really need that much in the way of clothing, or will the sweatpants do? So those kind of retailers have been affected. But broadly speaking, goods spending has been actually very healthy. It's services, it's airlines, it's conference centers, it's hotels. It's all the things that we would like to be doing, going to an actual basketball game. All these things, that's where the missing consumption is. And I wouldn't be surprised, in fact, that when COVID is over, you actually see a little bit of a dip in goods consumption. The retailers who have been shut out in this, like the clothing stores, will benefit. But broadly, including all that e-commerce, we might actually see a bit of a weakness or a softening in goods consumption, more than offset by going back to normal services consumption when this is all over.
Well, I mean, I bought a badminton set. I'm not sure if I'm going to go back to the well on getting another badminton set. And you raise an interesting point about services. Those who are kind of fighting the inflation story ask, when you can get back out, are you going to go to a restaurant every night? Are you going to get on a plane every day of the week? And it kind of sets us up for bigger conversations around what happens with rates being low for so long, especially through the housing market. You might have seen the comments, but I'll share them with you again. The former Bank of Canada Governor Stephen Poloz was talking with Amanda Lang yesterday and acknowledging where we are. And when it comes to what's been happening in the housing market, he said, quote, yes, it's hot and we could see signs of speculation, but we have to accept that because otherwise we would have a really, really bad recession. And we were comparing those comments to what your Bay Street colleague David Rosenberg had told us recently, where he was basically weighing in on the housing situation. And he said the following: this might be one of the biggest bubbles of all time. Of course, it's been predicated on where mortgage rates are. We have a situation where home prices are up 18% year over year with practically no wage growth. It looks like a dot-com stock in 2000. Where do you weigh in on all of this, Avery?
Well, if there's a bubble in something, it's actually a bubble in calling a bubble in the Canadian housing market. Because actually, if you go back over the last decade, I don't know how many forecasts I've seen for people saying the housing market is going to crash, it's going to crash. And I have to admit, there were occasions where we thought there would be a bit of a correction, at least. That really never happened. So I think, we have to be careful about thinking that it's all going to tumble. I think Governor Poloz has it right that we are, to some extent, overstimulating the housing market because we need to stimulate the economy at large. And when you use low interest rates to help that, you can't pick where the money is going to go. When mortgage rates do start to rise, we will probably see a little bit of a cooling or at least a leveling off of house prices in Canada. There may be some markets where we see actual price corrections, but I think it's an easy sport to come up with yet another housing price decline forecast. And those who did it in the past, those didn't really work out. Housing prices are, of course, higher than ever in most cities. So I think, yes, there's some truth that there's a bit of excess here. We won't need as much strength in housing when the economy recovers from COVID. We'll rely on growth in other sectors. And if we do see house prices retreat a bit, I don't think that that's going to be a calamity for the economy at all. Remember that mortgages that are being issued today, we are testing those mortgages in terms of the people's ability to pay higher interest rates 2-3 years down the road. So the ability to pay is still there for the people who are buying. Those who are buying houses are the people who've stayed employed during the pandemic. Actually, if anything, their financial situation has been improving because they haven't been taking trips. They've been saving some of their money. And so it's not that surprising that some of them are saying, if I'm stuck at home, I want a nicer one.
Well, you made that point about all the money that actually has been saved up. Hey, Avery, thanks a lot to consider, including